You ever notice how the world works in contradictions? America launches strikes, missiles fly over Tehran, the Middle East holds its breath, and me, the US dollar, I get stronger. It sounds backwards, counterintuitive, even a little amoral if money had morals, which I don't. But for the past 72 hours, that's been the reality. The dollar is having its biggest surge in months, and the question everyone is asking, from Wall Street to your kitchen table, is why? I'm Money. Let's talk about the paradox of war and the dollar. Why, when the world burns, everyone comes running to me? Here's what most people don't realize. A currency's value isn't about who's good or bad. It's about perception, stability, and math. And right now, despite, or maybe because of the escalating conflict, the math and the perception are lining up in my favor. Meet Alex. Alex has a savings account, a 401k, and a mild panic every time they check the news. Alex is wondering if they should move their money into gold or crypto or just stuff it under a mattress. Alex is seeing the same headlines you are. US strikes Iran. Oil prices spike. Markets volatile. And they're thinking, the US is at war. Shouldn't the dollar be weak? It's a logical question, so let's answer it. Factor number 1, the flight to quality. In a crisis, investors don't look for growth, they look for survival. They look for the least risky house in a very dangerous neighborhood. Now, you might be thinking, isn't America the one dropping the bombs? How is that safe? Here's the thing, safety isn't about being uninvolved, it's about being unshakable. The United States has the deepest capital markets on Earth, it has the most stable legal system, and, whether you agree with it or not, it has the military power to protect its own assets and interests. When war erupts, capital doesn't just sit still, it flees. It flees emerging markets, it flees European equities, it flees anything that looks fragile. And where does it go? According to Bloomberg, it's flooding into US dollars in short-term treasuries. This massive spike in demand, it's not about loving America, it's about surviving the storm. And that demand automatically drives the price of the dollar up. Factor number 2, we have to talk about oil. War in the Middle East inevitably means one thing: oil prices go up. Why does that matter for me? Because of the petrodollar. Global oil is primarily priced and settled in US dollars, always has been. When oil prices spike, nations that import oil, Japan, Korea, India, most of Europe, face a brutal reality. They need more dollars just to buy the same amount of energy. As Reuters and the Korea Joang Daily reported, currencies like the South Korean won weakened directly after these strikes, partly because of this exact mechanism. This creates a global dollar shortage. Every country is forced to compete against one another to acquire the dollars they need for energy, and that competition strengthens me even further. It's a feedback loop. Conflict spikes oil, oil spikes demand for dollars, the dollar goes up. Factor 3. This is where it gets a little mathematical. War is inflationary. It destroys supply chains. It makes shipping more expensive. It spikes energy costs, which trickles down to everything, from bread to bus tickets. The financial markets know this, and they're always looking forward. They anticipate that the Federal Reserve, the big boss of US interest rates, will have to keep rates higher for longer to fight this new wave of war-driven inflation. Higher interest rates in the US attract foreign capital like moths to the flame. If you're a global investor and you can get a safe 5% return by holding US dollars or treasury bonds, why would you park your money in a volatile currency in a conflict zone? You don't. You move your money to where it's safe and it pays. That influx of foreign capital is another massive pillar holding up my value.
Factor 4 is a concept economists call the dollar smile theory. It sounds fancy, but it's simple. The dollar tends to strengthen in two very different scenarios: when the U.S. economy is booming and when the global economy is in a deep crisis. During a global shock, like the one we're in right now, risk aversion peaks. Even if the U.S. is the source of the geopolitical tension, I still smile and rise. Why? Because compared to the alternatives, I'm still the least risky bet on the board. It's not that I'm perfect, it's that everyone else looks worse. Factor 5 is something that makes this time different from the oil shocks of the 1970s. The U.S. is now a major net exporter of energy. In the past, high oil prices drained the U.S. economy. We were dependent on foreign oil, so expensive energy was a tax on America. Today, high oil prices bring capital into the U.S. energy sector. It's a massive boost to the domestic economy. This makes the U.S. economy, and by extension me, much more resilient to the energy shock of war than Europe, Japan, and China.
Factor 6. This one is a bit darker, but it's real. The United States controls the pipes of global finance, systems like SWIFT. When the U.S. enters a conflict, the threat of financial sanctions becomes very real. We saw it with the collapse of the Iranian rial. We saw it with Russian assets being frozen. Global entities, especially in countries not directly allied with the U.S., become terrified of being cut off from the dollar system. To ensure they can still trade on the global stage, they hoard U.S. dollars as a buffer. It's an insurance policy. They buy dollars not because they want to, but because they're afraid of what happens if they don't. This fear-based hoarding artificially inflates global demand for the greenback.
So, let's bring it all together for Alex.
Alex, this is for you. I'm ready for this!
My strength right now isn't one thing. It's 6 things happening at once. A panicked flight to safety, a desperate need for dollars to buy expensive oil, the promise of higher interest rates, the cynical logic of the dollar smile, the resilience of U.S. energy independence, and the fear of being cut off from the global financial system. Does this mean war is good for the dollar? No. War is destruction. It's human tragedy. It's uncertainty. But the financial system doesn't run on human tragedy. It runs on cold, hard, logical flows of capital. Alex's $100 bill is still in their wallet. It still says 100, but right now, compared to a euro or a yen, it's a fortress. Not because the world is safe, but because, for better or worse, in a world on fire, people will always run to the fire station that looks the least likely to burn down. So, what do you do with this information? 1. Don't confuse short-term strength with long-term invincibility. The dollar is strong now because of a specific set of circumstances. Circumstances change. 2. Understand that diversification isn't about betting against America. It's about betting on yourself. Holding some assets in other currencies, in gold, or in tangible things isn't unpatriotic. It's prudent. 3. Pay attention to interest rates. The Fed's path is the single biggest factor for my future value. And remember what I always say, I am not a reward for virtue or a punishment for failure. I am a tool, a very complex tool that reacts to fear, to math, to oil, and to power. Right now, the world is scared, and scared money runs to me. That's the paradox. That's the reality. I'm money, and whether you're confused, concerned, or just watching, I move. If you want to understand the next move of this chaotic financial chessboard, hit subscribe, take care of your hours, and maybe hold on to a little bit of the physical me, just in case.